Hi everyone. Welcome to another video in my Accounting for Investments lecture series. This video is going to be all about debt investments. So if you haven't already watched my video on equity investments, I suggest you go watch that first because that kind of lays the groundwork for the idea of holding investments and this idea of unrealized versus realized gains and losses and the impact that's going to have on the income statement. And that's going to make understanding debt investments a whole lot easier if you've already watched that and gotten a grasp of that. If you are ready to jump on in, then stay on board and we're going to talk about debt investments now. So I started off my equity investment video with a class poll asking about, as an investor, what would you like to see with respect to equity investments on the financial statements? I'm now going to ask you those same questions, but I'm going to ask them about debt investments. And you may think to yourself, well, why would my answer change? Because an investment is an investment. But there is a difference. With debt investments, often there is a predetermined payout on the investment. That's what makes it debt, right? You've lent somebody money, and assuming you hold the investment until it matures, right? The day it pays out, whatever that agreement is on that loan arrangement, you get paid, right? So it's like a guaranteed amount. And so that makes them a little bit different than stock investments, because stock investments just fluctuate up and down with the stock market, and at some point you choose to sell and you lock in the price at whatever you sell at. With debt investments, yes, they do fluctuate in the open market, but you could just choose not to participate and wait for the guaranteed payout. And so that makes them a little bit more complicated, and it makes this question a little more complicated. So let's ask the question. As a user of financial statements, how would you want a company's debt investments, which have a predetermined payout, reported on the balance sheet? Do you want them reported A, at the current value based on current market trading price, or B, at the historical cost, which is based on that predetermined payout amount? So take a moment, pause if you will, just ponder over this. Would you treat these different than equity investments? Or would you treat them the same? What are your thoughts on the matter? And then when you're ready, come on back and I'll talk through each of these options. Okay, so you're still with me one way or another. Either you came back or you stuck along. Let's talk about this. As with the question when I asked on the equity investment slide, there's no right or wrong answer, but there are some things to consider here. A debt investment. For those that tend to argue that they would still want to see it at the current value based on current market trading price, their argument is the company could sell the investment at any time at the market price, right? And therefore, it should show that market price as the valuation of the investment on the balance sheet. So that's kind of the general argument for students that tend to choose A. Students that tend to choose B argue, well, the company just needs to hold on to it, and the profit is already known. Therefore, don't fluctuate with the market. Just keep it on the books at whatever that value is, because you already know what the cash inflow and the profit that will result from that cash inflow is going to be. And so that's kind of the two sides of the argument. Again, there's not a right, there's not a wrong. It's just two different opinions of what you'd like to see with respect to these investments. But you know what's coming next if you watched my equity investment video. I'm going to ask you the same question, but about the income statement. So, as a user of financial statements, would you want the temporary changes in a debt investment's market value to affect net income, knowing that that debt investment is going to have a predetermined payout at some point, which essentially gives you a predetermined profit as well? Now, there's more complexity to that, but we'll talk about it when we actually get into debt. So yes or no, would you want that to affect net income? So think about it a moment, come back when you're ready, and I'll talk through this as well. All right, so Here's the deal. When we did equity investments, it was like choice A and choice A go hand in hand. And the same applies here. If you are in the camp that you would like to see debt investments on the balance sheet at the current market price, well, in order to get them to that current market price, you have to record a journal entry, and that journal entry is going to end up affecting net income. And so sometimes people argue, well, again, company could trade at any time, right? So it's kind of the same argument. The company could trade it away at any time. And therefore, treat it like an equity investment. Equity investments, if their value changes, it hits net income, the balance sheet is updated. So if you can trade a debt investment just like an equity investment, then do that. Treat it the same way, right? And so that's kind of the argument for A. The argument for B follows from the argument for B on the last slide. Why do this if payout and profit is already certain? Now, of course, the problem with that is the certainty assumes you're going to hold the debt investment until that predetermined payout, that you won't trade it early. Whether a company does or doesn't is kind of unique to every situation. And so not all companies do actually hold to maturity, but that's the argument to be made. Why would you affect net income for fluctuations in market value if everything is already predetermined? So, and of course, B and B go hand in hand here. If you are going to keep something on the books at historical cost, then that means you're never going to make an updated journal entry, which means you're never going to record an adjustment to net income. So B and B go hand in hand. That leads us into a little bit of a situation then, because debt investments are not equity investments, but they can be treated as such. All right, and that's where the complications start to come in. So let's kind of cover that in our overview, and then we'll walk through examples. Debt investments, just to be clear, are ownerships of another company's debt instruments. So when you hear things like bonds being traded on the bond market, you're talking about debt instruments. You're talking about companies that are trying to raise money by essentially taking a loan from others. Just like equity investments, debt investments might be current assets, they might be long-term assets. Again, it all depends on whether management intends to hold 1 year or less, right? 1 year or less is current. 1 year or more is long-term. I should say more than a year is long-term. And then here's where we get into the nuance. We are going to give debt investments 3 different classifications within the fact that, okay, it could be a current investment, it could be a long-term investment. Regardless of that, now you're going to have 3 different classifications that you give these investments, and the classification is going to determine the accounting. So you may be scared of that look and saying, well, there's 3 classifications. Does that mean there's 3 different ways to account for equity, for debt investments? And the answer is yes, there is. And that seems really crazy, but you might understand why. I hope you understand why once I kind of explain what those different methods are and how this works. So on the one end of the spectrum, let's think of this as a spectrum of decision making. Management has a debt investment. They could say, we're going to treat this debt investment just like an equity investment. We have no intention whatsoever to hold it to maturity. We're going to play the market, and when it suits us to make a profit, we're going to sell this thing. If that is what management's intent is, that's what we call a trading debt investment. No intention to hold to maturity. Okay, so no intention to hold to maturity. Essentially, they are treating it like equity. Treating like equity. Now, you'll notice right below here, I say any fair value changes. In other words, as the value of the investment changes, you are going to run those changes through net income, and you are going to update the balance sheet to reflect those changes. That may sound familiar to you. And if so, it's because we just talked about that in the equity investment lecture video. You are treating these like equity? Well, that's not just in concept, you're going to treat them like equity from an accounting standpoint as well. So everything we learned for equity investments, reapply that knowledge to trading debt investments because it's exactly the same. Okay, and it's because you're treating those debt investments like equity investments. So that's one end of the spectrum. The other end of the spectrum is held to maturity. All right, held to maturity is every intention to hold to maturity. So this is the exact opposite of trading, right? You are not going to play the market. You don't care if the market's going up, if the market's going down, because you're holding that thing until the day it gets its designated payout, period. That's your intention. If that's the case, and you don't care about whether the price is going up or down because you're not playing the market, you're not going to make any fair value adjustments. In other words, when you get to the end of the accounting period, if the price has gone up, oh well. If the price has gone down, oh well. You're literally going to leave this thing on your books at the price that was established when you bought it, because that price is based on the payout that the debt instrument is going to give you when it matures. And that's it. You just leave it alone until maturity date. So that's the other end of the spectrum. And that does make sense. So you might be thinking, why are all these different accounting treatments? Well, it's because it makes sense based on the intent, right? If something is treated like equity, account for it like equity. If something is going to be treated like it has a predetermined payout, then account for it like it has a predetermined payout. Where things get really hazy is in the middle. Available for sale. Available for sale is essentially the hybrid of these two extremes. Available for sale means, we don't know if we're going to hold it to maturity. We might, but if the right offer comes along, we're willing to sell it. It's available for sale. We're not actively pursuing sale, then we'd be trading. And we're not actively holding to maturity, that would be held to maturity. We are simply holding it and it's available to sell if the right offer comes along. That's available for sale. Okay, so this is kind of the middle ground between the other two extremes. Middle ground. Willing to sell or hold. Now that puts accounting in a bind, right? Because if you might sell at a moment's notice, then maybe you should account for it like an equity investment. If you might hold it to maturity, then maybe you should account for it like a held to maturity designated payout investment. But you can't do both. And so what happens here is the accounting straddles the line. You are still going to record fair value changes. You are still going to update the balance sheet to reflect when this thing goes up or down in value. And you are still going to record unrealized gains and losses. However, those unrealized gains and losses will not go on the income statement. All right? They are not going to affect net income. And you may be saying right now, well, if not, where are they going? And we'll talk about that by the end of this video. All right, so that's the overview. As with equity investments, here I'm just going to take you through the gamut of what are the transactions that can occur. We can buy the debt investment. It can go up in value. It can go down in value. We can sell it, right? That's kind of our 4 options on the menu. And we have 3 types to deal with, but we're going to walk through another example where we go through those 4 actions, and on each slide I'm going to cover the 3 types to show you, well, here's what happens in this type, and this type, and this type, and how they compare and contrast. So let's kick it off. Flyer Corp purchased $100,000 worth of Blue Devil Corp bonds on August 3rd, 2018. Record the purchase of Flyer Corp's stake in Blue Devil Corp under each debt investment treatment. So our treatments are, we have trading, we have available for sale, we have held to maturity. By the way, you see these acronyms I'm using, T, AFS, HTM, get used to them. You're going to see me write them all the time. I would encourage you to use some acronyms like that as well. It just makes life easier than spelling that all out constantly, right? What's happening in this situation? Well, we bought $100,000 worth of Blue Devil Corp's debt, and it was on August 3rd. So the journal entry date does not change for anybody, right? Doesn't matter what you're classifying these things as. It's August 3rd, 2018. And in all situations, we are spending $100,000. So credit cash, credit cash, $100,000, $100,000, $100,000. And here's the thing, you're going to notice, like, this is what happens. Even though we have these three different accounting treatments, there is going to be a lot of overlap. There's just going to be slight differences between them. So all three situations, we're spending $100,000 cash. In all three situations, we are getting a debt investment in return that is going to be an asset. So debt investment, debt investment, debt investment. And that debt investment is worth $100,000. Just gonna, since I drew my credits and debits separate from one another, there's a little bit of spacing there, might be confusing, so this will help clear that up. All right, so there's our journal entries. Now you may say, well, wait, all those journal entries are absolutely identical. And they are, but there is going to be one thing I'm going to encourage you to do. Because the accounting for all of these things is going to subsequently be different. On the day you buy, it's not any different. You paid cash, you got the investment. Doesn't matter what you classified it as. But subsequent to this, the accounting is going to change. And so you need to keep track of what type of investment you're dealing with. And so even though the journal entries look the same, you're going to want to clarify right behind that debt investment in parentheses what type it is. Is it a trading? Is it an available for sale? Is it a held to maturity? And you're going to want to do that because you are going to account for these differently, and you are going to have to track them separately in order to do that accounting properly. Okay, so that's the only difference on the purchase side, is identify what type it's going to be, but beyond that, there's not anything that changes from one method to the other. But let's get to the end of a year where we lose value on the investment. Things are definitely going to be different between the three types now. So trading, available for sale, held to maturity. Let's cover the two extremes first. You'll find that available for sale makes a lot more sense if you understand what's happening at the extremes, because available for sale is going to be the hybrid. For trading, so we're now at 12/31/2018. So that's the date of the journal entry, no matter what version we're using. It says, as of Flyer Core's fiscal year end on December 31, 2018, its debt investment in Blue Devil Core is worth $95,000. All right, so remember, it was worth $100,000. It is now only worth $95,000. So we have had a $5,000 loss, right? $100,000 minus $95,000 equals $5,000 loss. All right, record the unrealized loss under each debt investment treatment. Let's deal with trading first. Remember, trading is treated just like an equity investment. And an equity investment, every time the value changes, by the time you get to the end of an accounting period, you adjust the investment and you record an unrealized gain or loss to the income statement. So in this case, we have an unrealized loss. So that's going to be our debit of $5,000. And we've got to lower the value of the investment, debt investment, trading, $5,000. All right. Let's go to the other extreme, held to maturity. Under held to maturity, you don't care about fluctuations in market price until the day you either sell or until maturity hits and you get paid. It doesn't matter. You're holding it to maturity. Price goes up, price goes down. It's irrelevant to you if you're not playing the market. And so for held to maturity, we've got not applicable. There is no journal entry on this day. Why would there be? And so that's kind of your other extreme. Do an equity investment style journal entry. Do no journal entry at all. Which now brings us to this middle ground, this available for sale investment. We still have a loss, and we still have the debt investment value going down. But remember, the key difference is the loss is not going to run through the income statement. And so how do we deal with that? Well, we're still going to write debt investment, trading, and take $5,000 off of it. That's our credit. And we're still going to have a debit for $5,000, but we're not going to simply call it unrealized gain or unrealized loss. Instead, what I'm going to encourage you to write, and there's different verbiage you'll see around this. Sometimes you'll see it say fair value adjustment. Sometimes you'll see what I'm going to show you, unrealized gain or loss. There's different ways to write it, but here's my version. unrealized gain slash loss, parentheses, OCI. That's a mouthful, right? All right, what am I doing there? Well, first of all, we have an unrealized loss on this thing, and we have to keep track of that. But it's not an unrealized loss on the income statement. And that's why you don't see me writing unrealized loss, because unrealized loss is the account that goes on the income statement as a reduction of income, right? In this case, we are going to have essentially a placeholder account where we keep track of the ups and the downs in our available for sale security. And I'm calling that unrealized gain slash loss. As I mentioned, and I'll just write it up here in red, just you might see fair value adjustment, right? Or something of that nature is often another phrase you'll see for this account. This right here is an equity account. Instead of running a revenue or an expense through the income statement, we are literally going to take a hit directly to shareholders' equity for this fair value adjustment. I say take a hit because it's a loss, but if it was a gain, it would actually make our equity look better. But this is an equity account where we are going to track both the ups and the downs. Now, because it's a debit, we know that it's a loss in this case. If I write this account on the credit side, we know it's a gain in that case, but we're tracking it all in the same account. And there's a reason for this that's going to be very clear when we get to the sales part of the transaction. For now, just go with it. Know that that's what we're doing. Know that it's going to make sense later. Also, just a kind of a preview of things to come. You see, I put in parentheses behind this OCI. Now, I've actually talked about this briefly in an earlier lecture series, but it's going to come back in full force now for a minute. OCI stands for Other Comprehensive Income. This is income based on uncertainty, basically. You have your net income that comes from the income statement, and that's based on what is essentially taken to be certain events. Now, we know that there's some unrealized stuff in there from equity investments, from trading debt investments, so we know there are some uncertainties built in, but those are uncertainties with a high probability of likelihood, basically. Inside our accounting system, we're going to have a lot of things having to do with these AFS securities, having to do with pensions, that there's going to be a whole lot of uncertainty around them. And so we're going to have gains and losses that, just in the interest of full disclosure principle, we need to tell investors about, and yet they aren't things that are concrete enough to go on the income statement. And the place where we're going to show that is going to be what's called the comprehensive income statement. And so when we refer to all of these kind of uncertain gains and losses, we refer to them as other comprehensive income. So not things that are part of actual income, the income statement, but things that are part of a more comprehensive view of income, taking into account a lot of uncertainties. Okay, so that's what that OCI stands for. And we're going to talk more about that before this video is over, but just know that that's where that comes from. And so that's what happens for AFS securities. You're still recording the unrealized loss, although not to an income statement account. You're recording it to an equity account, and you are going to adjust the debt investment. So essentially, everything happens on the balance sheet, right? The asset goes down, equity goes down, and that's it. All right, so that's loss. If you understand that, the next slide, where we talk about gain, should actually be somewhat easy. So here we go. As of FlyerCore's fiscal year end in 2019, the debt investment in Blue Devil Core is worth $98,000. Record the unrealized gain. All right, so this is 12/31/19, 12/31/19, 12/31/19. Although you might stop me right there and just say, hey, guess what? That held to maturity, not applicable. Right? Because this is just another price change. And we don't care about those price changes under held to maturity. So not applicable. Remember, trading, just like equity. So the investment is currently worth $98,000. The last time we adjusted it, it was worth $95,000, right? And if you want to think of it in terms of a ledger, right? Here's our investment. We originally bought it for $100. And then we marked it down. We credited it for $5,000. which means it currently has a balance of $95,000. But it's currently worth at the end of the next year $98,000. So we have a $3,000 unrealized gain on this investment. The investment goes up by $3,000. We record unrealized gain for $3,000. That gain goes on the income statement. And you're done. That's the exact same thing we would have done if this was an equity security. So equity and trading, same treatment. And I'm going to put my T down here to just make sure I stay in that good habit. I don't know if I did it on the prior slide. Oh, I did, except I screwed up. So I knew something was wrong there. Debt investment, that was an AFS back there, so I'm sorry. If you caught me on that, great job. All right, so that's our trading journal entry. Now let's look at our AFS journal entry. Again, it's kind of the hybrid, right? So we're still going to update the value of the investment. So debt investment, AFS, for $3,000 because it's going up in value. But we are not hitting the income statement. Instead, we're going to use that equity account, unrealized gain/loss, OCI. All right, that's our adjustment account. And now you'll kind of see what's going on here is, if you notice back here, we took a $5,000 debit in that OCI account, that equity account. Now we're putting a $3,000 credit in that OCI account. So those are going to offset each other. So we're currently sitting at a $2,000 loss in that account from the $5,000 loss, the $3,000 gain. And so that's why we're kind of combining these two, because we're kind of keeping a running total in our equity. What was the net change of all of the fluctuations of this thing? We haven't run any of it through net income, but we need to at least keep track of what has happened in that fair value adjustment account. And that's it for the gain, right? So if you understood the loss, the gain isn't too bad. Now let's go to the sales. And here's where I'll tell you right now, this is where students, this is where they get lost. Not on the trading, not on the held to maturity, but on the AFS. This is just where it throws them for a loop. And so hopefully I've explained it up till now well enough that it won't throw you for a loop, but don't be afraid to rewind this part if you need to, just to catch it all. On February 1st, 2020, Flyer Core sold its debt investment in Blue Devil Core for $101,000. Record the sale, including any realized gains or losses under each treatment. So we have trading, we have available for sale, we have held to maturity. It's going to be February 1, 2020. So Feb 1, 20, Feb 1, 20, Feb 1, 20. Okay, good. All right, now trading. Again, just like equity. So one thing to consider here is it is a sales transaction, and we're selling for $101,000, which means in all three of these entries, we have a debit to cash, right? Because we're getting cash, $101,000. All right. What's also happening in each of these journal entries? Well, why are we getting the cash? We're getting the cash because we're selling the investment. And so there's going to be a credit to debt investment in each of these journal entries. Notice held to maturity matters now, right? Because we are selling. We didn't actually hold it to maturity. We're getting rid of it. And therefore, we need to make a journal entry, even though we didn't end up holding it like we intended to do. So now we've got the debt investment. So that's the trading. That's the AFS. Here's the HTM. And here's where things are going to start to look a little different from one version to the next. The held to maturity, if we just back up, what have we done in that account? Well, we debited it for $100,000 the day we bought it. And then we did nothing. And then we did nothing. And now we're at the day we sell it. So that held to maturity debt investment, that's just sitting on the books at $100,000. And so to get rid of it, we record a credit for $100,000, okay? And from here, things should be pretty clear as far as how to finish off the held to maturity, because we bought it for 100, we sold it for 101, therefore we made $1,000, and so we're going to record gain on sale $1,000, and that journal entry is finished. So held to maturity of all of these is the absolute easiest, right? All you have to do is record the day you buy it, and then you just wait. And if you happen to sell it, you get rid of it for the price you paid for it, record the cash, the difference is a gain or a loss. So that one's actually the easiest. Let's go up to trading now. The debt investment under trading. All right. We originally paid $100,000 for it, so debit $100,000. Then as we saw here, we recorded a $5,000 credit. That brought it down to $95,000. And so that's where we left off with this T account right here. It was at $95,000. But now we've debited it for another $3,000, which is going to bring this $95,000 up to $98,000. And that's what it's currently sitting on the books at, $98,000. And so that's what needs to come off the books, is $98,000. And of course, the difference between these is a gain on sale of $3,000. All right, now let's raise the red flag for a minute, because you may be going, well, hold on. The gain on sale was only $1,000. We see that with the held to maturity. You bought it for $100, you sold it for $101, you only made $1,000. Why are you recording a gain on sale of $3,000 under the trading method? Well, it's for this reason. Remember, under the trading method, we've been recording gains and sales all along. Gains and losses all along. In fact, if we were to tally them up, we originally recorded a $5,000 loss. Then we recorded, not in parentheses, a $3,000 gain. And now in this journal entry, by the sheer way the math is working out, right, we're selling a $98,000 investment for $101,000. We're recording another $3,000 gain. And if you sum all those up, it's going to come out to a grand total $1,000 gain. So even though we look like we're recording a higher gain under trading upon this sale than under held to maturity, the grand total effect over the entire life of the investment is 100% the same. We made $1,000, regardless of which method you're using. Okay? All right, so that's trading and held to maturity. Here comes the one that confuses everybody. So I'm gonna tell you right now, if you don't understand trading and held to maturity, stop, rewind, make sure you come to grasp with both of those first, because understanding both of those is going to be paramount to understanding this kind of hybrid, this AFS. All right. Under AFS, the debt investment. The debt investment has been updated every time the price changed, just like trading. And therefore, the debt investment is going to have to come off the books at $98,000, just like trading. Okay? And I'm gonna make like a little connection here, right? Just like trading, because you've been treating it the same way the whole time. The most common mistake I see at this point when I grade student exams is they put this together, cash 101, debt investment 98, and then they go gain on sale 3,000. And that is absolutely not right. And the reason for it is this. Under the AFS, you have not run a single gain or loss through the income statement the entire time. Remember, held to maturity, you didn't run any gains or losses through the income statement either. You bought it for 100, you sold it for 101, your actual gain was 1,000. Under trading, you ran a bunch of gain and losses the whole time, but sum total, they came up to 1,000. Under AFS, you have not yet run any gains and losses through the income statement. The gain you need to record on this sale is 1,000, the true gain. And that is going to match the gain from the held to maturity. Here's where that whole hybrid thing comes into play, right? This is why we did AFS the way we did it. We updated the balance sheet just like if it was trading, but we avoided the income statement as if it was held to maturity up until this point in time. And so you have to record a gain on sale of 1,000, the true gain that will now go through the income statement. The problem that that's going to lead to, and you may have already caught it, is if you look at this journal entry, it's definitely not balanced, right? You have cash of 101,000, and then you have a credit of 98 and a credit of 1. So you only have 99,000 in credits versus the 101 in debits. We are 2,000 short on the credit side. And so we need something over here, another $2,000 on that credit side. And then the question is, well, what is $2,000? And here's where you got to keep in mind what we've done special about AFS. Remember, we did adjust it every time its value changed. But instead of hitting the income statement, we made an adjustment to equity, this fair value adjustment account, or as I call it, the unrealized gain loss OCI account. It went up by 5. Then it went down by 3. Or I should say it went down by 5 and up by 3 if I'm talking realistically, because it was loss then gain. If I were to draw that as a ledger account, I'm just going to call this I'm just going to write OCI instead of trying to spell that whole phrase right here. We debited it for 5. We credited it for 3. It is still sitting on our balance sheet. It is still sitting in shareholders' equity with a $2,000 balance in it. In other words, there's still an account on our balance sheet that says, hey, we have a $2,000 unrealized loss from this investment. But remember, we're selling the investment. We can't keep reporting an unrealized loss on the balance sheet for something that we're not even going to have anymore. So what do we need to do? Well, we need to get rid of it. We can't leave that on the balance sheet when we get rid of the investment. How do you get rid of a $2,000 debit? You get rid of it with a $2,000 credit. And that's the missing piece of this journal entry, is unrealized gain/loss OCI. You've got cash coming in, right? So that's the debit to cash. You're getting rid of the investment. That's the $98,000 credit. When you get rid of the investment, you also have to get rid of that unrealized loss in your equity account that's related to that investment, because you can't have an unrealized loss on something you don't even own anymore. And so that's a $2,000 credit. And then you can plug, at that point, if you haven't already figured out what the true gain is, you could just plug, well, there's a $1,000 gain that belongs in this transaction as well. And that's where AFS ends up being a hybrid. You're adjusting the debt investment as if it was trading, but you're ignoring the gains and losses until the very end when you record the true gain or loss as if it was held to maturity. Okay? And that's it. This right here, AFS, that's as tricky as investments get. I'll warn you right now, and it screws up students on exams all the time, because it's just so hard to wrap your head around this idea of, well, we're making adjustments just like trading the whole way, but then at the end it doesn't act like trading. But the difference is trading is always affecting net income. AFS does not affect net income until the day of sale. And this is how it plays out. All right, let's talk about our income statement. So I already kind of showed you this slide where I added in, I've been kind of keeping track of this the whole time, of growing and growing and growing the need for a better income statement. And on the equity lecture, I showed you this slide where we added this idea of a non-operating section to the income statement. The only reason I'm bringing it back up now is I just want to point out that any unrealized gains and losses from your trading debt investments, because they act just like equity investments, they go in these non-operating revenues and expenses. So they're always hitting the income statement. Also, any realized gains and losses, regardless of debt type, is going to go in that non-operating section of the income statement. But then we have something special. We have the AFS unrealized gain and loss account. And that goes beyond the income statement, because that's not going to hit net income. And so what we're going to now have, and you're going to see it when we get into the next video lecture series, is we're going to have something called the comprehensive income statement. And so we're going to have our net income from our income statement, right? So if I were to kind of mark this down, from income statement. And then we're going to add in all of these kind of weird, uncertain things. The only one we've learned so far is this AFS, unrealized gains or losses. But in your advanced accounting courses, you deep dive into pensions, and a lot of pension stuff goes in here. There's some other miscellaneous stuff as well. And what's going to happen is all of that uncertainty is going to wind up as part of something we call other comprehensive income. And that other comprehensive income is going to show up in two places. It's going to show up on what we call the comprehensive income statement, and it's going to show up in shareholders' equity on the balance sheet, right? Because it's essentially an equity account that we're adjusting to avoid the income statement. And so this is just a sneak preview of things to come. We will talk way more about comprehensive income when I cover that video lecture series, but just know this is what happens with AFS. So not only have we created a need for a more expanded regular income statement, but now we've created a need for even more detail that goes beyond the income statement. And this is where the more complicated financial statements start to arise from. All right, so that's it for accounting for investments. We've got equity investments. We've got 3 types of debt investments. The accounting treatment is different across the board. But if you can remember conceptually, this is what I always stress for students. Don't try to memorize those slides. All those slides I did in this video, in the equity investment video, where I walk through the 4 different types of transactions and I show you how it's different, students time and time again try to memorize those slides. Don't do that. Memorize the concepts. Understand what makes an equity investment an equity investment. What makes a trading investment a trading investment. How is a trading investment different from a held to maturity? How is available for sale a hybrid of the two? If you understand what makes them what they are, then you'll understand, oh, well, because of this, I'm not going to run the gains and losses through net income. Oh, because of this, I am going to run the gains and losses through net income. Oh, this one I'm going to adjust on the balance sheet. This one I'm not. You'll know that if you understand conceptually what these investments represent and how management's intention affects the accounting for them, okay? So do not try to memorize these slides. Learn what the investments are and reason through why you would account for them in a certain way because of how they are. Okay, so that's kind of my pro tip to you, and that's a hard thing to think about, but definitely try to do things from that angle. Okay, so that's it for investments. I'm going to do some practice problems on these, but I hope you found it informative, and I hope you join me for the practice problems. I hope you join me for my next lecture series, where we are going to get into now the need for that income statement and the comprehensive income statement. And other than that, I hope you have a great day.